about to get a whole lot smarter. Today, we're diving into episode 54 of the renowned Wealth Management podcast by Gyani Sharmaji Academy.
It's not just any episode. We're talking about advanced financial strategies that are reshaping how wealth is managed in 2026.
Welcome to the Co-Pilot podcast. Did you know that a simple change in how you arrange your investments can slash your portfolio risk by 40%? Today, we're diving deep into the world of Indian wealth management, exploring how smart asset allocation and diversification can transform your financial future. You'll learn practical strategies for building wealth, managing risk, and navigating India's dynamic financial markets.
And it's fascinating how many investors overlook this fundamental principle while chasing the next hot stock or investment trend.
Right? It's like they're playing a game without knowing the rules. So let's start with the basics. What exactly is asset allocation? And why is it so crucial for Indian investors?
Well, asset allocation is essentially how you divide your investments across different asset classes, like equities, debt, gold, and real estate. According to recent research, this distribution actually determines 80 to 90% of your portfolio's behavior.
That's a staggering number. So you're saying the specific stocks or funds we choose matter less than how we divide our money?
Exactly. Think of it like cooking. You can have the finest ingredients, but if the proportions are wrong, the dish won't taste good. The latest data shows that Indian investors who focus on proper asset allocation tend to weather market volatility much better.
Speaking of market volatility, I've heard there's a simple rule of thumb for deciding how much to put in different assets. Can you share that?
Yes, one common approach is the age-based rule. You subtract your age from 100 to get your equity allocation percentage. So if you're 30, you'd aim for about 70% in equities and 30% in debt and gold.
That seems pretty simplified. Surely there are other factors to consider?
Absolutely. You need to consider your job stability, risk tolerance, and time horizon for major goals. For instance, someone with a stable government job might be able to take more investment risk than a freelancer with variable income.
Let's talk about something interesting that's happening right now, the new Securities Markets Code Bill 2025. How is this changing things for investors?
This is actually a major overhaul of India's capital markets regulation. The bill consolidates 3 separate laws and expands SEBI's board from 9 to 15 members, with stricter conflict of interest norms.
And what does that mean for the average investor?
It means better protection. The new code requires SEBI to complete investigations within 180 days, so you won't have cases dragging on forever. It's bringing more transparency and efficiency to the market.
That's really encouraging. Now, let's talk about something that's uniquely Indian, our love for gold. How does that fit into modern portfolio strategy?
You know, that's a fascinating cultural aspect. While traditionally Indians have held physical gold, we're seeing a shift toward more efficient options like sovereign gold bonds and gold ETFs.
Really? Why the shift?
These modern instruments offer better liquidity and eliminate storage concerns. Plus, sovereign gold bonds even provide an additional 2.5% annual interest, making them more attractive than physical gold.
Let's switch gears and talk about technology. How are digital platforms changing wealth management?
Digital platforms have democratized investing. Now, anyone with a smartphone can access mutual funds, stocks, and even start systematic investment plans with just a few hundred rupees.
That's incredible. But does this easy access come with risks?
Definitely. While technology has made investing more accessible, it's also made it easier to make impulsive decisions. That's why having a solid asset allocation strategy is more important than ever.
Speaking of strategies, what's your take on mutual funds versus direct stock investing?
For most investors, mutual funds offer better diversification. Recent data shows that professionally managed funds, especially index funds, provided more consistent returns compared to direct stock picking.
What about debt investments? With interest rates changing, how should investors approach this?
Debt portion of your portfolio should include a mix of government-backed options like PPF and EPF, along with high-quality debt mutual funds. This provides both safety and reasonable returns.
You mentioned PPF, Public Provident Fund. That's quite popular in India, right?
Yes, PPF is a favorite because it offers tax benefits under Section 80C, provides guaranteed returns. It's an excellent foundation for the debt portion of your portfolio.
Let's talk about risk management. What are some practical strategies investors can use?
The key is regular portfolio rebalancing. If your equity allocation has grown beyond your target percentage, You should sell some and reinvest in debt or gold to maintain your desired asset mix.
And should investors rebalance their portfolios?
Most experts recommend reviewing your portfolio quarterly, rebalancing when allocations drift more than 5% from your targets. This helps maintain risk levels while potentially improving returns.
That makes sense. Now, what about international diversification? Should Indian investors look abroad?
Absolutely. International exposure can help reduce country-specific risks. Many Indian mutual funds now offer international fund of funds, making global investing accessible.
And what percentage would you recommend for international exposure?
For most Indian investors, starting with 10 to 15% of their equity allocation in international funds is reasonable. This provides meaningful diversification without excessive currency risk.
Let's talk about something that often confuses investors, the difference between diversification and asset allocation.
Think of asset allocation as your master plan, how much you put in different asset classes. Diversification is about spreading risk within each asset class, like owning different types of stocks or bonds.
That's a helpful distinction. Now, what about real estate? It's traditionally been a big part of Indian portfolios.
Real estate can be valuable for diversification, but it's important not to over-allocate. REITs, real estate investment trusts, now offer a more liquid way to invest in real estate.
Speaking of new investment options, what's your take on alternative investments?
Alternative investments like AIFs, alternative investment funds, can add diversification, but they should typically make up no more than 10 to 15% of a portfolio due to their higher risk and lower liquidity.
Let's talk about a common mistake you see investors make.
One of the biggest mistakes is chasing past performance. Just because a particular asset class or fund did well last year doesn't mean it will continue to outperform.
It's a great point. How can investors avoid this trap?
By focusing on their long-term asset allocation strategy and sticking to it through market cycles. Regular rebalancing actually forces you to buy low and sell high.
What about emergency funds? How does that fit into asset allocation?
An emergency fund should be kept separate from your investment portfolio. Aim for 6-12 months of expenses in easily accessible, low-risk instruments like savings accounts or liquid funds.
That's a good point about life stages. How should asset allocation change as we age?
Generally, you should reduce equity exposure as you age. It's not just about age. Major life events like marriage, children's education, or approaching retirement should trigger portfolio reviews.
What about tax efficiency? How does that factor into asset allocation?
Tax efficiency is crucial. For example, equity investments held for over 1 year enjoy more favorable tax treatment than short-term gains. This should influence which assets you hold in different accounts.
Let's talk about monitoring investments. How closely should investors watch their portfolios?
While it's important to stay informed, checking your portfolio too frequently can lead to emotional decisions. Monthly or quarterly reviews are usually sufficient for most investors.
That's helpful advice. What tools do you recommend for portfolio tracking?
Many mutual fund platforms now offer consolidated portfolio views. Even a simple spreadsheet tracking your asset allocation percentages can be effective.
As we wrap up, what's your number one piece of advice for Indian investors?
Focus on getting your asset allocation right first. It's like building a house. You need a strong foundation before worrying about the interior decoration.
It's a great analogy, and it really brings home the importance of proper planning.
Exactly. Remember, successful investing is more about discipline and proper asset allocation than finding the next multi-bagger stock.
Well, that brings us to the end of today's episode of Co-Pilot Podcasts. Remember, whether you're just starting out or managing substantial wealth, proper asset allocation is your key to long-term success.
And don't forget that 40% reduction in portfolio risk through diversification we mentioned at the start is achievable for anyone who follows these principles consistently.
Thanks for joining us today. Keep building that wealth, one smart allocation at a time.